This is a recording to go over the assignment provided in the intro class for forecasting, income statement, and looking at the break-even for the products. So again, going over the assignment that was provided, the assignment was that a company has two product lines, product line A and product line B, and the baseline is starting at 2012, and the quantity sold in 2012, which is the baseline year for product A, is 1,500 at the price of $3.50. Hence, the total sales, which is price multiplied by the quantity, is $5,250. Product B, 2,500 quantity sold at $4.50, and the sales price times quantity is $11,250. The other information provided is that based on the marketing analysis that they have done for their products A and B, they've concluded that they expect the quantity for product A to grow 3% a year, which means every year the amount sold for product A will be 3% higher from the prior year. So 2013 will be 3% higher than 2012, and 2014 will be 3% higher than 2013, and so on. And they expect the price that they can increase is 3.5% every year. So price will grow 3.5% from one year to the next one, another 3.5%, and so on. And similarly for product B, the quantity growth at 5% and the price growth at 2.5%. The other thing, as I mentioned when I gave you the assignment, that we want to do is to make sure these growth rates are independent variable. And that means that when we are trying to forecast the implications of these growth rates on what happens to the future sales and the profitability, we should be able to change these numbers, and the whole Excel spreadsheet should automatically calculate the numbers. So for example, let's say after we created the spreadsheet, our marketing people decided that because of the competition or because of the economic downturn, we can only grow product A at only maybe 2%, and we may not be able to grow the price at 3.5%. It could be something different, could be 2.5%. By these being independent variables, we can go in and quickly change these things, and everything else should change. And that is one of the value of using an Excel spreadsheet, and something that is critical and important to do a business analysis, and obviously very critical for MBA students. The next piece of information that is provided as a baseline is to say, okay, what about the cost for making each one of them? The variable cost, which is what we had discussed in the lecture when I was talking about variable cost versus fixed cost. So variable cost for the product A, for example, for this particular company, is that it takes $3 to make each one of them for product A, and $2.50 for each one of them for product B. And again, we also have to keep in mind that these variable costs and the other operating costs will have an effect of inflation. So that's why these over here have to be accounted for with the inflation. So we have an inflation number over here. The company is assuming that the inflation on average every year will be 3%, and that's again should be an independent variable. So if we change that number in the future, everything else that is related to the depreciation will change. The other piece of information they've given us is the depreciation is 100, and that is going to stay constant, and the interest is 200, and that's going to stay constant. They're not expecting any change in the future. Their operating expenses, or their fixed cost, is about $7,000, and that will also grow with the inflation. The tax rate they're expecting is going to be 20%. So that's the information they've given us. Again, in a summary, two product, A and B, quantity for each this year, price they're selling it for this year, their forecast for growth, quantity, 3% for product A, 5% for product B. Price growth, how much can they increase the price every year? 3.5%, 2.5%. Inflation assumption 3%. Product cost, variable cost, how much it is. The depreciation 100. Operating expenses 7,000 and tax rate. This, based on this information, the assignment I'd given you was to go in and calculate an income statement and also look at the average break-even quantity. And I suggested that in order to get the most out of Excel and have good skills of putting it together, I recommended to do it in tabs. First tab, put in the sales and the variable cost, and I also recommend doing the graphs and so on. So now what I am going to do, so this was the assignment given to you. What I have done is also provided you, through Professor Rosner and through Professor Peros, the copy of these Word document that I am using, so you know the answer. And your goal is that if you did not get it right the first time, is to redo it and see if you can replicate the solutions or the answers. I have not given you the Excel files. I've given you the screenshots on a Word document. And your assignment as a redo assignment is to go in and redo your Excel spreadsheet to be able to get to these answers. Because as I mentioned, it is part of the learning for an MBA program. And you should all be able to do this thing in order to, feel comfortable with these kinds of analysis, both in, at work, or if you're going to start a business, and or obviously through the MBA program in some of the courses. So here are the solutions. Again, putting it in the front, these are the assumptions we have. How much is the quantity and the price? What is the market forecast? 3%, 5%, the same information that we had talked about before. Now, first step, I would recommend, if you're doing it for the first time using Excel, is to look at the things that are going to grow and be able to figure that out. So for example, first thing what I've done is to say, okay, let's look at the prices. The prices they have given us is that in 2012, we have $3.50 for product A, $4.50 for product B. What we want to do is to now first calculate what would the prices be in the future years, 2015, 16, 17, and so on. Now, in order to do that, we basically are taking $3.50 and we're growing it by the price growth rate, which is 3.5%. So the way the formula would work in the Excel is you are going to take this number times 1, you're going to put a parenthesis, 1 plus the growth rate, which is 3.5, and you're going to get this number. If you use a calculator, what you would do just to test it out to make sure the Excel spreadsheet is giving you the right answer. And again, it's always a good habit to check few of the numbers in your Excel spreadsheet just by a calculator to at least you know that you have not made some error in your formula, so the numbers are working. Okay, so the first thing you're going to do is obviously figure out the price growth over the next few years for product A and product B. We do the same thing for the quantity. Grow the quantity based on the growth rate. The quantity growth rate is right here, 3% and 5%, and we grow the quantity in the future. Next thing we do is to look at the variable cost. We know in the first year they've given us $3 and $2.50. Now we want to do is to grow. So we do the same thing. We grow the percent growth, which is inflation in this case, 3% every year. So it is growing 3% every year. Same thing in product B, it is growing 3% every year. And again, with the calculator, you want to check to see at least a couple of points in here to see if your Excel is doing what you hope it is doing. Now that you have the quantity growth and the price growth, you can then figure out the sales. The sales is going to be obviously quantity times quantity, which is 1,500, times the price 350, and you get this number. So from an Excel perspective, this thing over here would be this cell and that cell. Okay. What I'll now do, now that I can explain you the the format, I am now going to go to the Excel spreadsheet that I am using. And again, these screenshots have been provided to you, so you know the answer. But now let me go to the Excel spreadsheet, so at least you can see why the formula linkages are important. So I'll open the Excel spreadsheet. So here is the Excel spreadsheet. I'm not going to go through all the steps because, but I'll show you a couple of them. So at least this way you can see what the formulas are or what the relationship is in case if you did not get it right in your first time around. So step one, like I said, I wanted to do was to figure out the price as it is growing. So I would take the price in 2012 and I want to grow it to 2013, 2014, and so on. How did I do that? So let's go look at 2013. 2013, what I am doing is I am taking the price. So here's the formula up here. I'm taking the price from the prior year, which is B15, that's a cell, B15, multiplying it by 1 plus the growth rate. And the growth rate for price is right here in right here over here, price H5. So the growth rate is 3.5%, but it's in cell H5, so that's why it is 1 plus H5. And so now we get that number. If I want to go do this here, I'll do the same thing. I'll take the price from the prior year. So you can see C15 is right here, which is 3.62, multiplied by 1 plus H15, which is again this number over here, and so on. So that's how we do the price growth. Quantity, same thing. We are basically going to take the quantity for the prior year multiplied by the growth rate for the quantity. So the quantity is, prior year is right here, which is B19, 1 plus G5, which is right here. This is the growth rate of G5. And that gives me this growth rate. If I want to go to the next year, I will take this year, the prior year, again grow it with this growth rate. So the formula will be C19 now, which is on the C column and 19 row, multiplying it by 1 plus G5, which is again this number over here, 3%, and then you go through it. Now in order to get the sales is price times quantity. So I would go to the price, which is right here for 2013 for product A is C15, and multiply by the quantity for product A in 2013, which is C19. So that's what the formula is, C15 and C19. That gives me over here. So I'll show you one more year. If I come over here, I need the quantity for 2014, which is right here, which is D 19, and the price is D right here 15. So you basically calculating the sales, which is price times quantity, and you do the same thing for product B. Then you add them up. Basically you're adding up this, and you're getting the total for the 2014. And so these are total for each year for product A and product B. We do the same thing for the variable cost. We know the unit cost for 2012 is 3. We want to grow it to 3 next year. So the formula is going to be B19, which is the prior year, multiplying it by, up here as you can see in the formula, 1 plus the growth rate, which we said was going to grow with inflation, which is B9, and that's why it takes the cell from here. So again, the variable cost is going to be prior year multiplied by 1 plus B9, which is where with the inflation rate we have plugged it in of 3%. Now this is what I mean when I said that these needs to be independent variable, which that means is that now we can go change in quantity rate for product A, for product B, price growth rate for product A, product B. We can change the inflation rate to say if the inflation is higher or lower. And because we have linked it to these assumptions for the growth rates, we can go in and do what if. Okay, so the variable cost, we grow it again, every year by inflation rate. So again, prior year times 1 plus B19 cell where the inflation number is residing. Once we have done the unit cost growth rate, we need the total cost, which is going to be each one. Say in 2013, it's going to cost $3.09, and we are going to make quantity of 5597, and that's going to be the quantity is 1545, and so now we have the quantity. So again, let's look at the formula over here. It is C30, which is the cost per unit right here, and C19, where we had the quantity. So now you can see that everything is connected, which means that if we go in and change a growth rate for any of these things, not only will the quantity change, the sales will change because sales are tied to the quantity, and also the total cost will change. Why? Because the cost is tied to the quantity. And so now we have the total cost. Now, one thing I've done over here, which we'll need it later on, but I did it over here because the information resides over here, is to look at the average price. Because we have two, product A and product B, we looked at the average price, and the average price is really looking at the total sales we are selling, dividing it by the total quantity. So the total sales is, so you can see the formula is B27 and B21, B27 and B21 up here. So total sale is B27, which is 7,704, and the total quantity combined A and B is right here, which is B21, which is 4170, and that gives us the average price combining both. So it is not average price of taking a price of 1 and adding it the price of 2 and dividing it by 2. This is also accounts for the quantity differences between the product A and product B. So to get the average accounting for the quantity, one way to do that is to look at the total sales combined for A and B and dividing it by the total quantity combined for A and B. Same thing with the average total cost. We do the same thing. We look at the total variable cost, which is C37, dividing it by the total quantity to C21. So here is C37, and then dividing it by C21, which is the total quantity. So what it does is basically provides you with an average price and average variable cost. I've also added on the bottom to see, okay, as the time goes on, are we creating more margin from the product? And the margin, which is typically the gross margin, as you see in the income statement, is the price minus cost. So this is nothing more than looking at B39 minus B40, which is the price minus cost, which means in 2012, for every, on average, we sold $4.13 sales per piece. On an average cost was this, and an average margin 144. Margin is growing in our example, so which is a good thing. You want the margin to grow because that means you have more money available that you can use later on to be able to pay for the other costs like your fixed costs, interest, and so on. Okay. Now that we have done the sales and the variable costs, next thing we want to do is to look at other pieces of the income statements. Okay, so here I basically brought this information up here so it is handy for us to look at it. But the piece I want to focus now is going to be your depreciation, your interest, your operating expenses, and the tax rate. We need that information to now calculate the net income. And again, I would like these to be, again, we want to do, assumption is that the variable cost and the operating cost will grow with the inflation. Now, when we did the variable cost, which is the unit cost on the prior page, let's go back to it. When we did the variable cost, we did grow it by inflation, so we did that already. Now, when we're looking at the fixed cost or the operating expenses, we also want it to grow at 3%. So let's create an income statement. Income statement, basically, let's go through the elements of income statement on the left column, and then we'll talk about the numbers. Sales, where did we get that from? We got that from the prior sheet, which is here. We know that the total sales are right here, so we're pulling it from that cell. So all we're doing is going in and coming over here, and we say plus that cell, and when you do that, it brings that number from the prior sheet or the tab right here, and then we just copy this whole thing, and all the sales number that we calculated before gets pulled up over here. We do the same thing for the total variable cost. We pulled it from the prior page. This thing is just a gross margin, which is subtracting sales from the cost, and we get this number. Depreciation, the assumption is going to stay fixed at 100, so we basically keep it at 100. Operating expenses starts at 7,000, but is expected to grow 3%. So we want to grow this number 3% every year. So you can see it is growing up 3% every year. How would we do it? We would take prior year times 1 plus B14, and B14 is where the inflation resides right here, and that allows us to calculate it. Interest expense, then the earnings before interest and taxes, that is the amount that is left before we pay interest and taxes. So what we're doing is we're looking at the gross margin, subtracting from it depreciation, subtracting from it operating expenses, and we get a negative number of 1350, which means this business in the first few years is not making money. Okay. Same thing. So now we put in the interest, then we get the earnings before taxes, and then we pay 25% taxes. Now, one of the nuances when you have a situation where you are not making any profit, so the question is, would you pay taxes or not? So here is a line for the taxes. Now for this class, I'm going to try to keep it simple. And the simple part would be, let the Excel calculate the number for you. And basically that would mean is that you will get a negative number over here, and then positive if you're making money. And then you do the net income. When you get into the finance class, we'll talk more about it. But at this stage, I want you to really learn how to forecast information. So as long as up to here, the earnings before interest and taxes, if you get this line right, then I think you've accomplished the learning outcome for this exercise. Okay, now, but how would we do income statements? So we'll continue. We basically pay taxes. You do the net income, which is this number over here. And then we get return on sales. Return on sales is net income divided by the sales, and so on. And so based on our assumptions that were given to us, the sales growth is right here. It's growing like that. Cost is growing. So our gross margin is growing every year, which is a good thing. But because we got some fixed cost, for the first few years, we are not covering a fixed cost enough, so you can see through at least 2017, we have a negative earning before interest and taxes. And hence, you would be not making any money, and then later on, as the business continued to grow, we started to make profit. Now, what is the value for something like this? If this was a real business situation, and if your business cannot tolerate this negative profit, you will then have to go back and do some what ifs. What if I can do something else? What if I can see if I can lower my variable cost by some amount? What if I can see if I can sell more so I can have more quantity? So you can do what if over here, and as you do what if, is your this portion over here that is based on sales and quantity and prices and unit costs will change, and they will allow you to see if you're making profit or not. Similarly, you can also look at your operating expenses in the real world and say, okay, I'm spending $7,000 every year in this example. What if I can figure out a way to cut that by $500 and do it for $6,000? So let's say, for example, I'll do right here. Let's say, what if instead of somehow we can do this saying our operating expenses, we can cut it down to say $6,000. So if I make it $6,000, you can see that a profitability situation will start to get better sooner, whereas before we were not making profit till 2017. Now we're starting to make profits starting in 2015. So here is the reason why I would like you to start to use Excel. Here is the reason why you can see the value you can get by doing some what if. So let me go back to the 7,000, which was the assigned number for the homework. So this is what it will look like. On the bottom is calculating the break-even. Break-even, the formula, as we've discussed in the other presentation that I gave you on break-even analysis. Break-even is a fixed cost divided by price minus quantity. And because in this case we have two products, A and B, which price do we use and which variable cost should we use? And that's why we did the average in the prior sheet. So I just pulled it over here from the prior sheet, so we have it right here. Average price, average cost, average price, average cost. And then basically this is the formula. Now, the other question that obviously comes up is to say, okay, what is a fixed cost and what is a variable cost? Why? Because we are using fixed cost as a numerator. So to make it simple, one of the things you may always want to think about is that the fixed cost is typically cost that does not change regardless of how many quantity you are making. So if it's a bakery, regardless if you make a 1 donut or 1,000 donuts, there are certain costs that will not change at all, or if they do, they're going to change very little. Like, for example, your rent will not change. Your insurance you're paying for your bakery will not change. If you have a property tax you pay to the town, that will not change. Utility may change a little bit if you're making less. For all practical purposes, utility will not change. So the costs that do not change are called the fixed cost. Now in the real world, there could be some that are not pure fixed, not pure variable, they could change, so on. But for intro level class, let's assume that there are only two categories, fixed cost and variable cost. Variable costs are going to change directly. So for our analysis, we assume that the cost of goods sold or the variable costs are basically the ones that are going to vary, and they are variable, and the other ones are not. So the fixed costs would include your depreciation, your operating expenses, and your interest. That's what it will include to be the fixed cost. Again, what are they? Your operating expenses, your depreciation, and your interest is considered as a fixed cost. And then the variable cost is the cost of goods sold as a variable cost. So in your formula, you're dividing the fixed cost, as you can see, I summed up B31, B30, and B33, which are the depreciation, the operating expenses, and the interest. Put in the parentheses so they're added up first, divided by the price minus variable cost, and again using the averages because you got product A and product B, we get this number. So you can see that our break even, which means we have to sell at least so many to be able to break even in our business. So hopefully this is helpful. I think you should go practice and do it and see if you can get to this point and be able to do this thing. An important part is start to get comfortable with the relationship between some of the variables that you should be able to change. So when you're creating an analysis for yourself, at least you know what independent variable you can change and how will it help you change your decision making and how you're going to change how you run your company. So